got banners. What's going on, everybody? Excuse me, I'm a little parched. This is the Kenyon Show weekly on Tuesdays, starting at 6:30. All right, today's episode number 3, I am going to be talking about how to build wealth. So I have some show notes here and everything today. We're going to get right into it today, making sure that y'all are getting the most out of this. And as always, if y'all haven't subscribed already, subscribe to the YouTube channel. Follow me or add me on Facebook. Each and every Tuesday, I will be bringing y'all gems to help y'all build your wealth and win at this game of wealth, because wealth is a game. Life is a game. Wealth is a game. I'm here to help y'all navigate that in the best way possible. That way you can build wealth for yourself, for your family, you know what I'm saying? Live a wealthy lifestyle. That's what it's all about. Lifestyle, not, easy, quick fix, you know what I'm saying, situation. I'm not into quick fixes. I'm not into short-term solutions. I'm into building long-term wealth. And again, every Tuesday, 6:30, I'll be getting into it. Today, I'm going to show y'all, or pretty much talk about, how to build wealth. I'm going to give y'all a formula to build wealth, and I'm going to also get into some steps you can take, literally step by step, how you can start building wealth and how I've built my wealth. You know what I mean? Y'all know me. I like to get real personal, transparent, show y'all exactly how I did it. That way, you know what I'm saying, you can relate and say, okay, like, I didn't come from a rich family. I come from a poor background, poverty background, things like that. So it's not so much that I was in a good position to build wealth to begin with. I found my way out of that position. So I always like to share that so people understand where I'm coming from when I talk about these things. And these are things that I'm doing or have done. I'm not talking about anything that I haven't done already or anything that I'm not currently doing. So that's worth noting as well. So give me a second. We're going to get into them and let everybody else join the live. Again, any questions you have throughout, any topics you want me to talk about in a future episode, as always, drop them in the comments, drop them in the DMs, ask questions while we're on here. Let's get real interactive. Again, because I'm here to help everybody win at this game of wealth so we can build wealth together, not just me by myself, not just people in my circle. I want to expand the amount of people who are building wealth. So if you're following me, that's the one thing I want to make sure that I influence you with, and that's building wealth. All right, so let me pull up something on my other screen and we're going to get started. We are going to get started. Hope everybody's having a lovely Tuesday. You know what I mean? The weather's starting to get good, starting to get nice out. So that's always a plus, you know. Just don't act up with those stimulus checks and that money just because the weather getting good, all right? We want to make sure that we're still being responsible. You know, enjoy yourself, but we want to be responsible. You know what I mean? You don't want to blow any opportunities. All right, so look, let's get right into it. So there we go. All right, bet. So look, how to build wealth. Let's get straight into it. I'm ready to go. We're ready to go. Everybody should be on by now. So if y'all ain't on, you know somebody should be on here. Hit them in a text message or something real quick. Yo, join the live. All right, so look, the formula to build wealth, it includes a certain amount of things, right? So in order to build wealth, you need money. Don't let anybody or any advice or anything tell you differently. You need money to build wealth, right? So whether that's income from a job, from investments, from anything, you need money to build wealth. Don't listen to anything. Oh, no money. Then you need money to build wealth. Money is a key part of the wealth building formula. You need money. You need capital. You need seeds in order to plant. You need money. The next thing you need is an investment vehicle or an asset. So something to put the money into. So you need to start with money, and then you need something to put the money into, right? And then the next two things are the most important things that a lot of people are not talking about, because again, people are into short-term solutions, which I am not into. I don't sell or give advice on any short-term solution. Everything is long-term, because long-term produces the best result, whether it's money, whether it's a healthier lifestyle, whether it's whatever kind of situation. Money produces a better result. I mean, not money. Long-term produces a better result, right? So look, you need money, then you need an investment vehicle or an asset to put the money into, right? After that, you need compound interest, and you earn compound interest over time. So again, the key part of the wealth building formula is the time, and the time. Because over time, you'll earn more compound interest than you would if you were to partake in a short-term solution or a short-term investment or a short-term vehicle, asset, whatever you want to call it, anything short-term that you're doing. Yes, you'll get a return from it. Yes, it will help your situation, but it will not give you the greatest return. So we're looking for the greatest return on our money in the sense that we're talking, because we're talking about wealth. We're looking for the greatest return, and the greatest return is long term, because the market is literally designed for long term investing. It's not designed. So a part of it is designed for short term, yes, but overall, the market is not designed for short term. So you got to have a long term mentality when it comes to wealth. So again, you need money. You need an investment vehicle or an asset to place the money into, and you need time, because time will earn you compound interest. That's the wealth building formula. That's it. It doesn't say you need $1 million. It doesn't say you need to make 100,000 a year. It doesn't say anything. You just need money. It could be $1, $2, $3, 10, 20, 100. It doesn't have to be a large amount of money. You just need to have money. You need to have an investment vehicle to place the money into, or an asset. And then you need time. The more time you have, the more compound interest you'll earn. You want to make note of that. The more time that you have, the larger your investment will grow. So that's why we don't need to waste our 20s and 30s blowing money, because we're blowing more money than we realize, because between 20 and 35, that's 15 years. 15 years of blowing money. Let's say you blew $10,000. You didn't just blow 10,000. You blew potentially probably $300,000, $400,000, but you didn't understand the concept of time. It's called the time value of money. It's called compound interest. Compound interest is how your money grows into millions and millions of dollars in those 401ks, in those IRAs, and in those stock accounts. You don't grow it to $1 million by trading every day. All right. So look, understand that concept of time and long term. So let's get into the first step. Number one, the very first thing that you want to do when it comes to building wealth is make the commitment to work to build wealth, and not work to make a living, or work to pay bills, or work to have fun. We're working to build wealth. We're not working to keep a roof over our head. We're not working to drive a decent car back and forth, or a nice car. We're not working to take vacations. We're building wealth for those things, but we're working to build wealth. You got to make that commitment up front. I'm working to build wealth. I'm not waking up in the morning to clock in nowhere that I really don't even want to be in the first place, just to make a living, to go blow the money that I just spent working my back off for something that I didn't really want to do in the first place, and I go blow it. Granted, yes, live your life, have fun, whatever, spend your money, you work hard for it, yes. But the concept of getting up every day and committing to go somewhere, you make the commitment anyway without even realizing it, but you're making the commitment the wrong way. You're committed to going to work to earn the money, but you're not committed to go to work to earn the money to build wealth. That's the difference. So the number one thing you need to do is make the commitment to work to become wealthy, and not work to make a living, or work to just have money available to pay bills and go on vacation whenever you want to. That's not living, because you'll have to do that for the rest of your life. So the first thing you want to do is make the commitment to work to become wealthy and not work to pay bills and enjoy your lifestyle. The number two thing you want to do after making the commitment, remember, commitment is first. Without making the commitment, the rest of it doesn't even matter. You can have a wealth building mentality. You can have the income. You can have the money. You can have the best asset in the world. But if you don't make the commitment to becoming wealthy, all of that will deteriorate over time. You won't sustain the wealth that you build if you don't make the commitment up front to build wealth. Number two, you want to have a wealth building mentality. Mindset comes after the commitment. All right. You have to think wealthy thoughts in order to not only build the wealth, but to sustain and maintain the wealth that you built. Again, commit up front. Right. Then you want to start thinking wealthy. How can I turn 100 into 1,000? All right. What's the best investment to give me cash flow? All right. Where can I put this $1,000 that I just received? What can I do with this $1,400 stimulus check? Let me spend 400 and not just blow the whole 1,400 because it's free money. Let me spend it wisely. Where can I put 1,000 of that at? That's going to help me later down the road and enjoy some of it because it was free money. You don't have to invest the entire 1,400, but having a wealth mentality lets you know that any money that you get, you got to understand where it's already pre-allocated to. So if you got a situation where you save 60% of your money towards retirement, 20% goes into investments, 10% goes into cryptocurrency, and then the other 10 to 20% you spend on yourself. That's the system that you need to have. And that's the mindset you need to have with every single dollar that you earn. So number one to building wealth is commitment. Commit to the idea that you're working to build wealth and not working to make a living. Number two, your mindset. You want to think wealthy thoughts. How can I increase my wealth? How can I increase my net worth? How can I grow my assets? How can I retire 20 years, 10 years earlier than the age society puts on us? How can, like, that's the questions that you need to ask yourself. That's the mentality that you need to be in, not working to just pay bills, working to save a little bit. That's not where you want to be. All right. So number one, commit. Number two, mindset. Number three, you want to start working on your foundation after you've made your commitment and after you learned the process of thinking wealthy. All right. So what I mean by start your foundation, at that point, you want to start working on risk management. You want to start working on things that'll help you hold up your wealth. So your foundation, it's like a house. You don't build a house by just going outside and start building on the ground. You got to make sure that ground is level. You got to see what kind of soil is there, right? Because if you build on it and the soil is not firm, that house gonna come down. But if your soil and your foundation is strong, you can put as much house on that soil as you want. Same with your wealth. If your foundation is strong, you can build as much wealth on that foundation as you want. All right. You can put as much money on top of that foundation as you can because it's strong enough to support that wealth. But if that foundation is weak and you start accumulating investment returns and you start getting passive income, at some point it's going to crumble because it's not built to withstand the amount of wealth that you just created. That's why people who become millionaires through the lottery, they have no foundation. So guess what? They end up broke because they didn't make the commitment to become wealthy. They don't have a wealth built mindset and they don't have a foundation. So it don't matter how much money they just, created through winning the lottery. You could win the Powerball for $1 billion. It don't matter. You're going to be broke again if you don't understand the first three things. Make the commitment to becoming wealthy, have the mindset of wealthy people, and then again, start building your wealth foundation. All right. So what's included in the foundation? Insurance is number one. Insurance helps you insure against things that'll rapidly decrease your wealth. So if you have insurance makes sure that if you run into a situation, you're covered. Car insurance, we all have our cars insured because it's mandatory. The rest of everything in our life should be mandatory as well, but it's not. Life gives us the choice. So you got to be smart enough and have the wealth building mindset to understand that you need insurance, life insurance, health insurance, liability insurance, homeowners insurance, renters insurance. All those other insurances are oftentimes voluntary, but they need to be necessary if you want to build wealth. All right. So you want to have your insurances set up. Next, you want to get rid of debt. Any high interest debt is not your number one priority. You want to make sure your high interest debt is taken care of. Anything over 5%, it needs to be gone, because there's no point in having investment returns of 8, 10, 12% if you got high interest of 6, 7, 24% on credit cards. Because at the end of the day, you hustling backwards. You're not even really making any money on your investments because you're paying out money to the banks in interest. All right. So you want to make sure that your high interest debt is paid off. So insurance, high interest debt. Next, you want to set up automated funding to your investment accounts and to pay off your bills. At this point, you don't really want to. Budgeting is great, but budgeting is just like dieting. It's short term. Again, we're working on long-term solutions, all right, to help us sustain wealth, to help us build wealth and maintain it over time. We don't want to just build wealth and do it real quick and then have it sit there. No, we want to build it over time. Understanding things are going to take time. All right. So look, you want to set up automated funding. So if you get paid twice a month, every 2 weeks, have your checking account linked up to your brokerage or your IRA or your 401, whatever it is, and have $100 go there automatically every time you get paid. So that way that happens over time, over the course of a year, you contribute like $3,000 to an account. Granted, yes, that's small, but again, time. Understand time. Understand that we're 20 and 30 years old. That's time. All right. So we have plenty of time for that account to accumulate and accumulate and accumulate and accumulate. It's gonna start revving up, because the more money that's put in there over time, the more interest is accumulating. Then the interest go on top of the money, and then that money, it just starts to roller coaster. It starts to go up. All right. So you want to start automating as much of your finances as possible. Set that up as a part of your foundation, because you don't want to be taking care of that later down the line. You want that to be something you do up front, so that way over time it's being managed and it's being taken care of. All right. So let me do this real quick. All right. So again, setting up your foundation is important. So insurance, life insurance, health insurance, mortgage, renter's insurance, liability, whatever it is, take care of insurance, because insurance prevents us from spending our investments and spending our savings on things that could happen in our life, especially things that can cost tens of thousands or hundreds of thousands of dollars. You want to prevent that by having insurance in place. And insurance, again, most people don't like insurance, but I'm telling you, insurance will save you behind in times where it needs to be saved. All right. So insurance, get rid of your high interest debt. Anything over 5% needs to go immediately. Then you want to start working on things that's 5% and below. Get those knocked out as well. Don't just pay those out over time. Get those knocked out ASAP as well, because again, we don't want to pay any interest on anything that's not producing cash flow. So any liability that's not producing cash flow needs to go. Oh, that's a bar. Any liability that's not producing cash flow needs to go. All right. So after step 1, make the commitment to become wealthy. You're working to become wealthy. You're waking up in the morning. You're going to a job to become wealthy. You're not going there to make ends meet. You're not going to a job just because that's what you think you need to do, and that's what everybody in the world has done for hundreds of years. You're waking up and going to a job because you're going there to become wealthy. You're using your paycheck to become wealthy. You're using any side hustle money to become wealthy. If you're a business owner, you're using the money that you pay yourself to become wealthy. Any money that you receive, you're using it to build wealth, to become wealthy. That's the commitment. The number one thing you need to do is make the commitment. Number 2, you want to have the mindset. Start thinking wealthy thoughts. Start reading wealthy material. Start digesting wealthy material. Stop pouring trash inside of your head. Drama, news, coronavirus, COVID this, Trump this, politics this. Get all of that dumbness out your brain and out your sight. Get it out. Start pouring in ingredients that are going to help you become wealthy. The ingredients are books, YouTube videos, stuff like live streams, podcasts, anything that you can get inside your brain and inside your subconscious. You want to start pouring that stuff in and getting the other junk out. All right. So mindset, having the mindset to become wealthy. Number 3, you want to build up your foundation. Again, you can't put anything strong on top of a weak foundation. Wealth is something that's strong. You cannot put wealth on a weak foundation. Get your insurance set up. Get rid of your debt. High interest first, low interest second. Set up your finances to be automated. Every time you get paid, money needs to be moving somewhere. Because if you leave it up to yourself, it won't happen. All right. Number 4, we want to start accumulating wealth. So this is the accumulation phase where you're actually starting to really ramp up your net worth and increase your wealth. So you want to start off this phase with safe investments that will keep your money in good shape. Most people shun these type of investments or these types of money moves because they don't produce a high return, but they're not designed for that. Again, this is actually the first part of accumulation is your foundation still. So while I just mentioned foundation, this is like foundation part 2. You want to put your money in places that are safe. Savings bonds. Look up I bonds on treasurydirect.gov. I bonds and EE bonds. Those are bonds that'll keep your money safe. They're with the government and they pay a decent amount of interest. And even I bonds are inflation adjusted. So that way it keeps up with inflation and still pays you a relatively small amount of interest every year to keep your money safe. And so if I put a $10,000 in now and I want to take it out 5 years from now, more than likely my $10,000 will still be 10,000 or a little more then. And that's the idea of it. So you want to put your money in safe places. Granted, all your money's not going to go there, just a portion of it. Again, we're building a strong foundation just in case the market crashes, just in case a situation happens with us where we owe money to something or something happens, we get into a situation, now we in a lawsuit or something, and now we got to figure out how to get $50,000. You know what I mean? Like, you want to make sure you're protected from those things that will and probably are going to happen in life. It's called Murphy's Law. Anything that can happen will happen. And understand that. That's life. All right. So you want to get those into investments. So while they pay little return, you want to look at bonds. You want to look at money market accounts, savings accounts, things like that. You want to set those things up first before trying to jump into the sexy stuff. All right. So again, they are designed to keep your money safe, to keep your principal safe. All right. So you don't want to lose money. That's rule number 1 of investing. Don't lose money. Rule number 2, don't lose money. All right. So with the accumulation, you want to build up an emergency fund. Recommendation is 3 to 6 months. I'm recommending 6 to 24 months. All right. Because I want everybody to understand 3 to 6 months. That's an old rule. Granted, that'll work for most people. But 6 to 24 months is what wealthy people do. Wealthy people don't just have 3 to 6 months worth of expenses saved. Wealthy people have 6 to 24 months. That's a half a year to 2 years worth of money available just in case something happens where somebody can't work, somebody can't manage anything, somebody can't do anything. You got up to 2 years worth of money sitting there for you to take care of yourself and your family. That's wealth. That ain't just, oh, I'm being financially smart. We're being wealthy here. All right. So 6 to 24 months of expenses. Granted, it doesn't have to happen all at once. It can happen over time, but your target should be 6 to 24 months of expenses as a part of your foundation. And you want that to be in a money market account. So because your money market account will give you a decent amount of interest. Not right now because interest rates are low, but in a good economy, you'll get about 1 to 2% of interest, even sometimes upwards of 2.5% of interest for putting your money in a money market account. Look to online banks as well, because they give better interest rates because the costs are lower to provide banking to consumers. So after your emergency fund, you want to have retirement funds. Again, all this stuff needs to be automatic. That's a part of your foundation. Your 401k or your 403b needs to come out of your check automatically, pre-tax. Your Roth IRA, if your job allows you to directly send money there from your check, cool. If not, have your checking account linked to it so it automatically takes the money over there. Again, your retirement funds and things like that, that's a part of your foundation. It's the slow investments that are going to build up over time. That's a part of your foundation. So your retirement funds, so emergency funds, retirement funds. Then you want to do general savings accounts. So if you have I recommend having at least 2 additional savings accounts. One for whatever you can name them, whatever. So for example, vacation fund and home down payment fund. Those are 2 separate savings accounts that I have. And let's say I take the vacation and then I buy the house. Now I can rotate those 2 into 2 different goals. Dream car, second house. Like, just have 2 separate savings accounts. That way you can always rotate those out for different savings goals. But that's a part of your foundation, having savings set up so you don't have to touch your investments. The whole point of foundation is so you don't have to touch your investments and so that you don't lose any wealth by going for goals and by taking on additional risk in life. All right. Now we're moving on to accelerated accumulation. So let me backtrack. Let me do the formula. Money plus an investment vehicle or an asset. Money needs to go into the investment vehicle or the asset. Then you need time and more time, because the more time, the more compound interest you'll earn. And the more compound interest you earn, the larger the wealth you'll build. So you need money, then you need somewhere to put the money, an investment vehicle or an asset. Then you need time, because time will earn you compound interest. That's the wealth building formula. Plain and simple. It don't need to make it no more complex than that. Number one thing that you want to do is make the commitment to becoming wealthy. Make the commitment to get up every day and work to become wealthy, not work to make a living. Number 2, you want to get into your mindset, your wealth building thoughts, wealth building mentality. Number 3, start building your wealth foundation, your insurance, get rid of your debt, automate your finances, set up your savings accounts, set up your bank accounts, set up your retirement accounts, set up all your accounts, get your foundation in order before you start funding investments and looking for what to invest in. Investing is part setting up. Putting the money in an account and buying the stock is the easy part. Understanding all this other stuff is the hard part. Getting your mind right is the hard part. Putting in the work to make a plan is the hard part. Making an investment, investing is easy. You put your money in an account and click buy. Now you own Apple. That's the easy part. This stuff is the hard part. Get this stuff out the way. Set up everything. Get your account squared away. Understand how much money you make, how much money you spend, how much you have available to invest, etc., etc., etc. Do the hard work up front. That's the foundation. Then you want to start accumulating. Accumulation to start is foundation part 2. Your emergency fund. 6 to 24 months is what wealthy people do. Not 3 to 6 months. 6 to 24 months. And again, it doesn't have to happen up front. It can be over time. Then you want to move into retirement accounts. Then you want to move into general savings accounts. Again, I just recommended everybody should have 2 to rotate out for different goals: vacation and home down payment. Then dream car, home number 2. Once you get those 2, car number 2, piece of land. You know what I mean? Have those interchanged out over time so that you always have 2 savings accounts set up to put money towards a goal separate from everything else, because you don't want your money mingling. That's the whole point of setting up a foundation. Now, after you set up your foundation, then you foundation part 2. Now you want to move into accelerated accumulation. This is how we start growing our wealth even faster. This is what a lot of people, this is step 5. This is the step most people start on. And y'all see how much I've covered so far, that most people skip all of that and go right into this, which is where you have the brokerage account. And this is where they have the real estate and the Bitcoin and the crypto, the trading. This is where people go to first, without understanding that you can have all of that all you want. At some point in time, life is going to knock you down, and you're not going to have no foundation to fall back on. You're not going to have no insurance just in case something happens, no emergency fund just in case life decides to happen to you, because it will. Like, you have none of that set up, but you skip to the fancy stuff. Like, that's not how you build wealth. That's not how you build generational wealth that everybody's out here preaching about. You build it by taking care of the stuff that's hard to do. It's hard to sit down and plan out your finances. It's hard to understand how much you make and how much you spend. This stuff is hard. That's why nobody talks about it. Nobody makes budgeting sexy. Budgeting is not sexy. Insurance is not sexy. Taxes is not sexy. But investing in Bitcoin is. Trading options is. Forex is. All that stuff is sexy. So if something's sexy, you should probably stay away from it. All right? So look. Take care of the stuff that's hard. The life insurance, health insurance, get rid of your debt, automate your money, understand how much you make, how much you spend, build up an emergency fund, become disciplined with your money before you start throwing it in the market. It makes no sense. Like, it's nonsense. Take care of the important stuff. So step number 5 is accelerated accumulation. This is how we're going to grow our wealth faster and larger. Again, this is after we set up the important stuff. savings accounts, making sure our money is safe and secure, making sure we have a system in place. Then you want to move into acceleration, brokerage account. That's the dividend stocks, the growth stocks, the Tesla, the Apple, things like that. You want to do that after you set up your foundation. With brokerage accounts, I recommend two. My strategy is two. I use one for a dividend portfolio, which is a growth and income portfolio. And then I use another one for growth stocks, aggressive growth. So that's the Teslas, the Apple, the Amazon, the Facebook, the Netflix. I use one account for those, and I use one account for dividends. And again, most of my money goes towards the safer investments with a greater return, with less risk versus high return with an exponentially exponential more amount of risk. So those aggressive growth stocks have a great amount of risk attached to them, and we need to understand that. So while they may be sexy, and provide us with $1,000 return in 5 years, if you would have invested $10 in Amazon in 19, nobody knew that. So don't pay attention to that. So I think a safe amount of money to play around in that is probably around 15 to 20% in the growth, and a good 30 to 40% of your money needs to go to your dividends or your income portfolio, because you want to build up income over time so that you can retire on that income. I'm all about building wealth so we don't have to work for somebody else. We can work on what we want to work on and live off our wealth. All right. So brokerage accounts, two for different types of investment strategy. Again, my strategy recommendations is income, which is dividend stocks, and then have another one for your aggressive growth stocks, which is, again, your Tesla, your Amazon, Facebook, Netflix, Google, things like that. Next, you want to look into getting real estate. I think everybody should have at least 1 or 2 rental properties. You don't got to be all extravagant and have 5, 10, 15. You ain't got to, nobody needs all of that. If everybody can understand that you just need 1 or 2 rental properties, a nice size dividend portfolio, a growth portfolio, and then your retirement accounts, I think everybody will have a decent amount of wealth if they just understood and followed that. You don't need to do nothing outside of that. It's not rocket science. It don't need to be any more complex than that. Build up a portfolio, have your savings accounts, have 1 or 2 investment properties, and live your life. That simple. It doesn't need to be any more complex than that. So again, everybody should look into having 1 or 2 rental properties outside of a dividend portfolio or a stock portfolio, I should say, and then your retirement accounts. And make sure that those things are being funded and taken care of every single time you get paid. That's the formula. It's that simple. It is not any more complex than that. And understand, again, it's going to take time, but that's now I won't say the correct way, but if you do that correctly over time, your wealth will grow exponentially. I'm only a year and a half, 2 years in, and I'm seeing like stupid results off just following the fact that I'm following what I'm teaching. I'm teaching y'all the way I've done it over the last 2 years. And like I said, the results is crazy, being that much in depth that I was, making those stupid decisions that I made over the last 5 years previous. Like the situation that I'm in now, I'm beyond grateful because of what the situation I was in. And again, like I said, just teaching y'all, understanding, like, yo, like where I'm at now, I'm telling you, follow this, give it some time, and you'll see. So after step number 5, we want to get into the super risky and speculative investments. Again, this is your fun money. This is the cryptocurrency, the trading, the Forex, stuff like that. That's what the super risky and speculative investments are. People need to understand that that's the risk. Bitcoin trade, that's the riskiest investment there is. Those are the riskiest investments there is out there. So people need to stop recommending it to any and everybody. It's not for everybody. And they need to stop marketing it that way. You need to do your own research and understand, if you look at an investment pyramid, those things are at the top, which isn't a good thing. That means that they're the most riskiest investments that anybody can partake in, right? So you want to make sure that you're investing in that bottom foundation first. Again, no point in having this part large and the bottom part small. That's why it's a pyramid. The bottom needs to be strong. So you put your money in stocks or dividends, or matter of fact, savings accounts, then bonds, then stocks, real estate, then ETFs, blah, blah, blah. And then At the very top, the most risky things are Bitcoin, cryptocurrency, things like that. So I think 5 to 10% of your money is a respectable amount for you to play around with those investments, because they can provide you with some decent returns over time. But I just want you to understand that is very risky. So don't put your money in jeopardy of losing all of the wealth that you just built up. Ain't no point. All right. So look, after that, the very last thing that you want to do is maintain your wealth and never spend the principal. Never spend the money that you put into an investment. So if you put $100,000 into building your wealth, do not spend $100,000 because now you at 150. Now you want to take 75 out. You just spent 25 of the 100,000 that you put in. What's the point of putting it in there if you want to take it out? So you need to understand that you need to maintain your wealth. Never, ever, 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 ever spend the principal. Live off the interest. For example, if you put $100,000 in a portfolio and it provides you $3,000 of income every year, live off the $3,000. Do not touch that $100,000 whatsoever. That's the point of setting up risk management, insurance, savings accounts, bonds, etc. So you touch those things before you get to even thinking about touching your investment. That's the point. You want to make sure that you're taking care of those things first. All right. So I have a couple of questions I'm going to get to. I'm at the Q&A portion. But before I do, I'm going to run back the steps and everything again. So number one, the formula. You need money. You need an investment vehicle. You need something to put your money into. Then you need assets. Right? You need assets to put your money into. Then you need time, and more time. Because time will earn you compound interest. The more time you have, the more compound interest you'll make. First thing you want to do, make the commitment. You're working to become wealthy. Number two, the mindset. You want to make sure you have the mindset to become wealthy. Number three, start building your foundation. Put your savings accounts together. Get your accounts together. Get your accounts in order. Get your financial house in order. Know how much you make. Know how much you spend. Get your insurance. Everything. Just set up the foundation. Don't do anything sexy with investing. Just get your stuff set up. Number four, you want to build your foundation, part two, and then start accumulating. But you want to accumulate on the safer investments first. The emergency fund, money market accounts, bonds, savings bonds, I bonds, and EE bonds through the government, retirement accounts, and then general savings accounts. Then you want to start accelerating your accumulation. Brokerage accounts, that's stock accounts. You want to have two of those for different investment strategies. Then you want to look into getting 1 or 2 real estate properties, understand what that's going to take for you to do that. Again, after that, you want to start looking into super risky or speculative investments. That's only 5 to 10% of your money. So if you have $1,000 to invest every month, you're only spending, what's that, $50 to $100 a month on the Bitcoin and trading. Understand that. Limit that, because that will not help you build wealth over time. It'll contribute to the wealth, but it won't help you build wealth. Understand that. It's just understand that basic principle. 5 to 10% of your money into those investments. And understand, if you want to put more money into that, increase the amount of money that you're investing every month. So if you want to put 1,000 into Bitcoin every month and you're limited to 10%, you need to make 10,000 a month, because 10% of 10,000 is 1,000. There go your 1,000. Make more money if you want to contribute more money to those things. But if you have a little bit amount of money to invest, you want to put that into safe investments or growth investments that are relatively safe in terms of risk versus reward. You don't want to risk the little bit of capital that you do have. And then number 7, you want to maintain your wealth and never spend the capital. Never spend the capital. All right. So let me get into this question. So I have, if anybody else have any questions of the episode, anything like that, drop them down. I will get to everything before I end the show. I went over a little bit today, but so what? Good information. Good. If I couldn't wait to do this episode, good information. So somebody said regular savings account or savings accounts that add interest and give more money for having an account. You want to put it into money market accounts. I know most money market accounts require you to have a minimum limit to earn the interest rate. So for example, the money market account that I used through Capital One, back when the interest rate was decent, it was 2%, a little bit over 2%. But in order to qualify for that 2% interest rate, you need to have $10,000 in there. So if you put 10,000 into a savings account like that, which it should be, because again, we're saving 6 to 24 months of expenses, you'll get that 2% interest rate. So you want to look at either it's called high yield savings accounts or money market accounts. They usually provide the best interest rates to keep your money at least growing at a respectable rate. So you're not really losing money. You're gaining a little bit of money every year. All right. So I don't think I have any other questions. Other than that, man, again, each and every Tuesday, 6:30, I will be doing a live stream via YouTube, Facebook, and again, I'm probably another 2 episodes. I will be on IG Live. So if you're on Instagram looking, if you haven't already, subscribe to the YouTube channel or add me on Facebook to catch these lives after episode 5. Again, anything anybody wants to know specific, hit me in a DM, comment on any of the videos that I post or whatever the case may be. I read everything and I will cover it. Again, thank y'all so much for watching, tuning in. This is the Kenyon Seller Show, and peace.